The U.S. economy is strong. By any measure that we look at today, U.S. growth, economic growth, is as strong as it's been in decades. If you look at the unemployment rate, let's say for people with a high school education or less, that is the lowest it's been in over 20 years. Demand for truck drivers, for warehouse workers, the demand for labor is very, very high, and that's indicative of an extremely strong economy. But when we look outside the U.S., in many cases, we're seeing a very, very different picture. Europe is doing okay, but not great. China is not doing well, and the emerging economies around the globe are a bit of a mixed bag. But clearly, within the global economy, the U.S. is a standout. When we look at China and the slowing growth, one of the concerns is it does have ramifications for the rest of the world. China is the second largest economy in the world. It is clearly a leader in manufacturing throughout the world. But more importantly, when we look back at the last two, what I'll call corrections in our markets, 2011 and 2015 and 16, both of those were led by slowdowns in China's economy. So China's slowdown is something that we are concerned about. Concern over trade and tariffs are an issue for the global economy, much more for outside the U.S. than for inside the U.S. And they get some blame. But I think the major driver today, and I think perhaps more importantly going forward, is the change in stance by the U.S. Federal Reserve. Going back to 2008, Federal Reserve, the U.S. Federal Reserve and central banks across the globe pumped incredible amounts of money into the global economic system. They did this by printing money from thin air and buying up assets, primarily bonds and stocks. Today, with a very, very strong U.S. economic backdrop, the Federal Reserve is able to step away from that process. We are, in essence, reversing what we did for the last 10 years. We are now selling bonds and sopping up cash. So, if you will, taking liquidity out of the system. Over time, this is going to change the way markets behave. It's going to change the way the economy behaves. It's the quantitative tightening, this reversal of putting liquidity into the system, that I think is going to be the major driver going forward for markets and a major driver for the economy. Not necessarily in a bad way, but it is going to cause things to be repriced. We are introducing, or if you will, reintroducing the hurdle rate for investment. The way I might think about this is not a new ballgame. This is simply going back to the original rules that economic systems have played by for centuries. There's actually a cost of money to invest, a cost of money to invest in capital. And I think we're seeing that transition, early stages of that transition occur today. So in today's environment, we have an environment that's very, very different than any that a bond investor that's been investing for the last, say, 40 years, 38 years certainly, has ever experienced. We're in an environment where the Federal Reserve is, because the economy is strong, is consistently raising short-term interest rates. At the same time, they're in a process of quantitative tightening, pulling dollars out of the system. This has never been done before. If you go back and you look at what the bond market has done for, again, the last 40 years, essentially what you've seen is interest rates generally declining, while bond prices have generally been rising. Around 2017, that changed. We're now in an environment where we see, I think the opposite is going to occur. We're going to see interest rates generally rise, while unfortunately bond prices should be coming down, very much like a seesaw. So today, when you're looking at the bond market, I think you need to approach it with a much different strategy, much different tactics than you would have over the last 40 years. I think you need to be more conservative. I think you need to be more aware of the risks. And I think you need to be aware of an environment that is very, very different. We believe we are now in an environment where interest rates should generally be rising, and perhaps for some time, years. And that's going to put downward pressure on bonds. So when we look at the markets and we think about the markets, there's a lot going on. Now, U.S. economy is very strong. Global economy is doing okay, but it's a little spotty. Federal Reserve is raising short-term interest rates. You have quantitative tightening going on, money being pulled out of the system. So, for the equity investor, it's like, wow, there's just all this stuff happening. And of course, there's midterm elections. We think it's creating a bit of an opportunity. As you know, we began to raise cash towards the end of last quarter and have allowed that cash to build up in our portfolios. So we're kind of going through right now and looking at things that we think are really good. We think there's huge opportunities in energy. We think there's huge opportunities in industrial manufacturing. And we think there's opportunities in a lot of areas of what I'll call emerging or disruptive technologies that have really come to the forefront over the last, let's say, 5 to 10 years. So when we look out right now, we're bargain shopping. We think there's going to be some great opportunities. Short-term volatility, could see the markets go a little bit lower from here. But when we look out, say, the end of this year into next year, we're extremely optimistic and are looking forward to buying stuff on sale.